Hey everybody, my name is Brian Winter. I'm a tax attorney and tax professor, and in this video, my goal is to make the QBI deduction easy for you to understand, so when you sit for your exam, whether it's in class, the CPA exam, or the enrolled agent exam, you're going to be able to knock this out of the park, and you're going to be able to pass those questions with confidence. So, in this video, I'm going to go through a few things. I'm going to talk about what the QBI deduction is. I'm going to talk about how we calculate QBI, qualified business income. I'm going to talk about how we calculate modified taxable income. I'll talk about the SSB, or sometimes referred to as the SSTB, so it's a specified services trade or business, or specified services business. I'm going to go ahead and then I'm going to talk about how we calculate the QBI deduction for businesses that have modified taxable income below the threshold, within the threshold, and above the threshold. And we'll work through some practical examples to make sure that you understand these concepts. Now, before we get into the first part, there's a few things I want you to know. First off, the QBI deduction, why was it even passed? Well, back in the TCJA, what we saw is the tax rate for corporations dropped from 35% all the way down to 21%. Owners of flow-through entities like partnerships, LLCs, sole proprietorships, S corporations weren't quite as excited because they weren't seeing those same type of deductions because they don't pay a corporate tax rate. So Congress responded by creating this QBI deduction to help put them on equal footing with a corporation. Okay, so that's the first thing I want you to know is why we have the QBI deduction. Secondly, what I want to let you know is in practice, I'm going to be honest with you. The calculations, you're going to be using different systems and they're going to be calculating your QBI deduction for you. So you may be wondering now, and as you go through the video, why do we need to understand how to do these complicated calculations? Well, here's the answer. We're not, as professionals, our job isn't just to plug in numbers and to give it to our client and say, okay, here's your taxable income, here's how much you owe in taxes, things like that. We need to be able to answer the questions for our client. If they're looking at, hey, why do I have this deduction of QBI, or why did I not qualify for this thing? This is a QBI deduction. We need to be able to explain why they qualified or why they didn't qualify, as well as for tax planning purposes. You know, the QBI deduction is a huge deduction for our clients, and there are things that we can do in order to help minimize their tax or maximize their after-tax position. So understanding how we calculate QBI is going to be extremely important so we can then incorporate it into our tax planning strategies, which is what the true value that we're adding to our clients. All right, y'all, let's go ahead and let's just jump into it. Let's start talking about how we calculate qualified business income, which is our next section. All right, y'all, so let's go ahead and we're going to start talking about calculating that QBI income, and then we'll talk about modified taxable income. The reason we're going to do this right away is on every single calculation that we use for QBI is requiring us to calculate 20% of QBI, which is often the starting place for us, and then we have a ceiling, which is going to be 20%. That's the most that you're going to be able to take. So sometimes people will say, hey, you take the lower of 20% of QBI or 20% of modified taxable income. Sort of. It's easier to look at it as 20% of modified taxable income is going to be the ceiling, and we're going to see these through a series of examples. But before we can get to those examples, we need to know what is included in QBI and what is included in modified taxable income. So on this part of the video, I'm going to talk to you about that 20% of QBI. Now, I will be honest with you. In many classes, you're not going to really have to worry about calculating the qualified business income. It's going to be provided for you. But I don't know your instructor, so I can't say that with a certainty. So I want you to have at least seen it. So we'll spend a little bit of time talking about at least the starting point and some things that we may see that are going to be some adjustments to it. So our starting point on this is going to be net business income. Okay, so for qualified business income, we start out with our net business income. Okay, well, what is net business income? So these are on your schedules, right? Because we have business income. We might see something on a Schedule C for our sole proprietorship. So if we went over to Schedule C, we'll see what our net business income is. If we have rental properties, it might be on our Schedule C. Or say that we have like an S corporation or a partnership, we could see it on our K1. So we're going to find those different net business incomes. That's where you're going to locate it. It's going to be on those different schedules that you have. And that's where we start out. All right. After we start out, on our Schedule K1 or C or E, depending on what we're dealing with, we now have to make some subtractions. And there's two different types of subtractions. So we're dealing with Section 199 for QBI. And what the code section says is you have to subtract certain things. So capital gains or losses are going to be subtracted from your net business income. So you look for those. Dividends. Look for W-2 wages that are paid directly to an owner. Okay, so to an owner is different. Later on, we're going to see what happens if you're paying W-2 wages to other individuals, but this is to the owner. And remember, partners don't necessarily get those W-2 wages. What they get is guaranteed payments, right? So we would treat guaranteed payments the same way. We would deduct those. We deduct foreign income. All of that is going to be subtracted out of our net business income, okay? On the table that I created, that's going to be called Step 2. Then we go, that's going to be called Step 1. Then we go to Step 2, and we're going to subtract out additional deductions. Now, the reason we do these additional deductions is because when we go to Schedule C or E, right, or the K1, these aren't included. These are already included in there. We have to go ahead and we subtract them out. So half of self-employment taxes, right? That's a deduction that we're able to take. So we have to subtract that out. We have to subtract out health insurance, right? Our health insurance premiums, retirement contributions. Those are all going to be different things that we're going to subtract out from our QBI. So we're backing those out, okay? Because they weren't already handled within our schedules. So what that leaves us is to get to QBI, we're going to take our net business income, right? That's our starting point. Then we have to go ahead and we have to subtract out the adjustments that we made in Step 1 and the adjustments that we made in Step 2, and that's going to get us to our QBI, our qualified business income. Like I said, I don't expect that you're going to have much on your exams that deal with that. So this is just something I want you to be aware of, to look through it. I don't believe your textbook really goes into the calculation on that, but I'd feel better if you know this part of it, just in case there's a question on your exam. So let's go ahead now and let's talk about the next component of it. Because if we're doing 20% of QBI and we're comparing it to 20% of modified taxable income, we need to be able to calculate our modified taxable income. All right, now that we've calculated our QBI, what we need to do is we need to calculate our MTI, our modified taxable income. Now, for modified taxable income, what we're going to do is we're going to start out with what are our W-2 wages. So W-2 wages can include a few things. We could have a side job, say $30,000 in W-2 wages plus our QBI income. Well, we're going to take those $30,000 of W-2 wages. We're going to be adding those in. Or maybe our spouse is a teacher making $50,000 a year. Great. We're going to now take our spouse's $50,000 because we're being taxed at ordinary income on that. We're going to now include that within our modified taxable income. So any of the W-2 wages you're receiving that are going to be included in your ordinary income, you're going to be taxed on it. So we're going to include it in our modified taxable income. Same thing. If you work for an S corporation and you have W-2 wages, you're being paid a reasonable salary, those are going to be included in your modified taxable income. When we talked about our QBI income, we said, we subtract out W-2 wages paid to the owner. Okay, that's fine. But if it's in W-2 wages, we include it for modified taxable income. So we're looking at our W-2 wages. Another thing that we look at is unemployment income, right? Unemployment income is considered a substitute for wages. So if we have unemployment income, we also include that. So we have our W-2 wages plus our unemployment income plus our QBI income that we calculated before. Okay, we still include that in modified taxable income. So W-2 plus unemployment plus your QBI income. Then we have to go through and we have to make a couple subtractions. There are two big ones. The first one's going to be your standard deduction. Your standard deduction, and it's going to depend on your filing status, single, married, filing jointly, right? It depends on that for how much your standard deduction is going to be. But we subtract out our standard deduction in order to get to our modified taxable income, or we subtract out our itemized deductions. We get one or the other. You know, this is a choice that you had to deal with in Tax 1. When you're doing your taxes, you have the below the line deduction. So that's qualified deduction. It's our standard deduction or our itemized deduction, right? You had to select the higher of the two. Same concept here. select the higher of your standard deduction or your itemized deductions. Okay, one final step. Subtract out your net capital gains. Okay, any net capital gains that you had are going to be subtracted out. Make sure you're not including those. They're excluded. The reason being, they're not going to be taxed at our ordinary income tax rate, so we're not going to include them. Because remember, when we're looking at our modified taxable income, this is serving as the ceiling for the QBI deduction. It doesn't mean we're going to get 20% of modified taxable income, but what it does mean is we're never going to get more than 20% of our modified taxable income. So if it's not being taxed at your ordinary rate, we're not going to be able to include it into our modified taxable income, which increases the total possible QBI deduction that we may be eligible for. What I will do now is I'm going to go ahead and I'm going to create some examples for you, and we're going to walk through those examples so you can calculate your modified taxable income to make sure we're on the same page here. All right, everybody, so now that we know the rules for calculating modified taxable income, let's go ahead and apply them, and let's make sure that we're all on the same page and that you're going to be able to nail these when you get to the exams. All right, so 5 questions coming up. First one's going to be, James owns a landscaping LLC, earns $50,000 of qualified business income. James's spouse is also going to be working, and she's going to be earning $60,000 in W-2 wages. Okay, so when we add those together, we now know our adjusted gross income, our AGI, is going to be $110,000. They're going to file a joint return, so their standard deduction is going to be $29,200. So we need to go ahead and figure out, well, what is our modified taxable income? Well, we take our AGI of $110,000. We're going to subtract out our standard deduction of $29,200. That's going to give us $80,800. That is our modified taxable income. We'll multiply that by 20%, and that's going to be the ceiling. We won't get a QBI deduction that's going to exceed $80,800. I'm sorry, 20% of $80,800. We may get less, but that will be our ceiling, 20% of modified taxable income. All right, let's try another one. The second problem is going to be Samantha. Samantha's going to be earning $40,000 from a consulting sole proprietorship. Still a flow-through entity, we're good. She also sells stock for $20,000 long-term capital gain. Hey, long-term capital gain is not going to be taxed at our ordinary tax rate. We're looking at 0, 15, or 20%. That's not what our QBI deduction is about. So we cannot include the $20,000 of our capital gains. So what we've got to do in this question is we've got to say, okay, so she earned $40,000. She's going to take her standard deduction of $14,600, and that's going to come out to $25,400. That's her modified taxable income. And that will be the ceiling for our QBI deduction, because we're going to go $25,400 times 20%. That's going to give us our ceiling amount. All right, so if you see a net capital gain, take that out. Don't include it in there because that can throw you off. Let's go to number 3, another problem. Now we've got Carlos reporting $35,000 of QBI income from a small business. He also received $10,000 of unemployment compensation. Hey, we talked about unemployment. That's not going to trip us up. His spouse earned $25,000 in wages. So now they're going to file jointly, and they're going to have $29,200 of standard deduction. Okay, so let's calculate this. $35,000 from the QBI. Yeah, we add that in there. We've got to add back the $10,000 of unemployment because that's the substitution for wages. So now we've got 35 plus 10, so we've got $45,000 as we're calculating toward AGI. All right, now we have to add in the spouse's $25,000. So our $40,000 plus 25, now we're at $65,000, right? Well, what we're going to do now is we're going to go ahead and we're going to subtract out the $29,200 standard deduction, and we're going to come out to $40,800. That is going to be the limit. We're going to go 20% times $40,800. That will be the ceiling for our QBI deduction, right? That's 20% of modified taxable income. Hey, on that problem, if I said that they had standard deductions of $21,000, or I'm sorry, if they had itemized deductions of $21,000, you would ignore it, right? You say, hey, $29,200 is greater than the itemized deductions, I'm going to take the $29,200. But if I did say that they had itemized deductions of, say, $35,000, you say, I'll take the itemized deductions of $35,000 because that is greater than $29,200. So you'd be taking the greater of those two. So a little bit of a wrinkle in that, but just to make sure that we're all on the same page. All right, I hope you all are getting these. I hope you're doing fine with this part. Let's go to another problem. Let's go to look at problem number 4. Let's see what we can do on this one. So Myra earns $30,000 QBI income from a sole proprietorship. All right, so we have QBI of $30,000. Her spouse earns $50,000 in W-2 wages. Okay, we know we include those. They have $15,000 of a taxable IRA distribution and $10,000 of qualified dividends. They file jointly. They have $29,200 for their standard deduction. Okay, so this one looks a little bit more complicated. Let's go ahead and calculate it. So we have 30,000 QBI plus 50,000 of W-2 wages, so we're at $80,000, right? We have 15,000 of an IRA distribution. Hey, IRAs, we put that money in, we get the tax deduction before, assuming this isn't a Roth, right? Assuming this is a traditional. We earn the money, we contribute it to our IRA, and we get a tax break when we first contribute that money, and then it grows with all that interest, and then at retirement we're going to start taking, now we're going to be taxed on all that at our ordinary tax rates. So since it's going to be taxed at ordinary tax rates, we need to go ahead and we need to make sure that we're going to include that as well. So we've got 50,000 and 30, so we had 80,000, and then we're going to go ahead and we're going to add in the 15,000 of taxable IRA distributions, so we have $95,000. By the way, the reason I know it's a traditional, not a Roth, is it says taxable IRA distributions. If it was a Roth IRA, it would have been non-taxable. Anyway, we're at $95,000, right? Then we have $10,000 of qualified dividends. Well, hey, are qualified dividends taxed at our ordinary tax rate? They're qualified, so you can't just say dividends, right? Qualified dividends aren't. They're going to be 0, 15, or 20%. They're not taxed at our ordinary tax rate. So let's not go ahead and include those. So let's go 95,000 minus our $29,200, and that's going to give us $65,800. So we know our modified taxable income is going to be $65,800, and if we needed to know our 20% cap, we're going to say 65,800 times 20%, and that's going to give us the ceiling for our QBI deduction. Let's try one more. Let's make sure we have this one. This is a little bit longer one. So we've got Taylor owns 100% of an S corporation. During the year, the S corporation paid Taylor $70,000 in W-2 wages for services provided. Okay, I added this question in there because I wanted you to see that for the MTI, modified taxable income, the $70,000 of W-2 wages that came from the S corporation is still going to be included. So we start out with that $70,000 of W-2 wages. The S corporation also reported $30,000 of qualified business income passed through to Taylor on the Schedule K1. All right. Let's see. We have, in addition, Taylor earned $10,000 in taxable interest income. Interest income is also taxed as ordinary income, right? It's taxed at our ordinary rates. If it's taxed at our ordinary rates, we need to go ahead and we need to include that as well. Okay, so now we've got our 70 plus 30 plus 10. It's going to give us $110,000. And now let's go ahead, and we have a single person with Taylor. Let's go ahead and take out our standard deduction of $14,600. And we're going to come out to our modified taxable income of $95,400. Now, I keep using these standard deductions, but you're going to be using the standard deductions in the year based on when you're reviewing this video. So it's not always going to be $14,600 or $29,200. You just need to know what your standard deduction is for the year that we're dealing with. Okay. So how'd y'all do on this? Hopefully you're following through. We still got some more to talk about, right? We've gotten through now understanding how we get to our QBI and our modified taxable income. Now all we have to do is we have to go through and say, okay, well, first off, what's an SSB? Because we got to figure out that. It's going to have some different rules for us. And then we're going to start applying our computations for if we're below the threshold, within the threshold, or above the threshold. So let's go ahead and let's look at an SSB, which is our next part, but we're getting there. Hang in there. Okay, so the next thing that we need to talk about is that SSTB, because we're going to have different limitations for SSTBs. An SSTB is a Specified Services Trade or Business. Sometimes it's referred to as an SSB. It's a Specified Services Business. They mean the same thing. So what happens if we have an SSTB? Well, if we're below the threshold, and we'll look at the threshold amounts in our next section. If we're below the threshold, nothing happens. Same test. That doesn't make a difference. If we're above the threshold, however, we get 0. We don't get a QBI deduction for an SSTB that makes more than the threshold. We'll get a QBI deduction for a non-SSTB above the threshold, but for an SSTB, a Specified Services Trade or Business, you'll get 0. Your answer will be 0. On the exam, if you see that you have an SSTB and they're making more than the threshold, stop right there, 0, move on to the next question. You got that one correct. Okay, it will be 0. So let's talk about what you should be looking for to see if it's an SSTB, so you can just answer 0 and move on. The types of businesses, the types of industries, right? So when you look at an SSTB, what Congress was basically saying is, an SSTB is a type of business to where it's the individual's reputation or skill set that is a true asset of the business. It drives the business, right? So it's their reputation or skill set. Okay, and it doesn't have to be one person; it could be several people, but it's a reputation or skill set that's driving the value of the business. And what Congress was worried about is if you're an SSTB, then you're going to be able to easily reclassify your money, the proceeds that you earn, the profits you earn, and instead of giving yourself like wages, you're going to just make yourself distributions from the QBI. It's going to all be QBI income. So they're worried about that portion of it. But here's your different industries that are going to be a SSTB, or the different professions. Look for medical profession, doctors, dentists, physician's assistants, psychiatrists, nurse practitioners. Look for that area. Lawyers, CPAs and accountants, performing arts. So anybody in performing arts, musicians would be inside that, right? You could be an athlete. That's going to be considered an SSTB. So if you see something like a doctor, lawyer, CPA, identify those as an SSTB, and if their modified taxable income is greater than the threshold, 0, you're finished with that answer. There are a couple little trick questions that you could be caught up on the CPA exam or the enrolled agent exam, or maybe your professor is going to try to trick you with this. And that's be for engineers and architects. For whatever reason, Congress excluded them from the definition of an SSTB. So if you see an engineer or an architect, they're a non-SSB. Such as, and others are going to be things like retail businesses. They're a non-SSB as well, or non-SSTB as well. The reason that they excluded engineers and architects, even though they look like they'd obviously meet the definition, is because they wanted to incentivize continued building, so they didn't want to use that as a deterrent. All right, so now that you have the definition of an SSTB, we can now go on and we can start to figure out how to do these tests. We're going to look to simplify this. So on these different exams that you're going to be encountering throughout your career as you're advancing in your profession, you'll be ready to handle those with confidence. All right, everybody, now's the exciting part. We finally get a look at this table that I went ahead and I created you. This is going to be section 199A. And what we get to do is we get to see, well, how much are we going to get? What is the test that we're going to be using for our QBI deduction? And there are several steps that we have to take. So the first step we're going to do is we have to determine what is our filing status. So in the little blue rectangular boxes to the left, we're going to see we have single, married, filing jointly. And if we look to the right of it, we're going to have less than $191,951 for single. We're going to have a $50,000 range within the phase-out amount. And then if we made more than $241,950, now we have a separate test. Same thing for married filing jointly. What we do is we double it. We double single. So if single was $191,951, now we're going to double that. It's going to be $393,901. And then if we're looking at married filing jointly. The single was $241,950. We're doubling that to $493,901. And then you can see within the yellow part, the range, it went from $50,000 to $100,000. So we double everything from single to married filing jointly. Is the way that this actually works. Now those amounts, $191,951 to $241,950, they're indexed for inflation, so they change every year. So when you're looking at this, it depends on when you're looking at it. That's going to determine what your phase-out amounts are going to actually be. So do make sure you consult with the most updated numbers as you're going through here. So what we did is we looked at our taxpayers filing status, and then we had to determine our taxpayers modified taxable income. Hey, we already did that. We said QBI plus W-2 wages. It could be unemployment. It could be interest income minus our itemized deduction or our standard deduction, right? And that gave us modified taxable income. So you've already mastered this part of it. So let's go ahead and take a look at this now. So let's say that we have a modified taxable income of $100,000, right? Well, if we do that, what happens is whether we're filing single or married filing jointly, it doesn't matter because our phase out is significantly is over $100,000. So if we're at $100,000, we're well below it for our modified taxable income. So we would take 20% of our modified taxable income and 20% of our qualified business income. And that's going to be the amount that we're going to be able to deduct, right, for our QBI deduction. Now, notice that in this green box, it says full deduction regardless of SSB or not. So if we have an SSTB, if we're an accountant, a lawyer, a doctor, right, performing arts, and we make less than that $191,951, or if we're married filing jointly, that $393,901, we don't treat an SSTB any differently. It's the same test. So the reason I colored that into a green box is that's a full go. We don't have to worry about anything. We're going to get the lower of 20% of QBI or 20% of modified taxable income, the 20% of modified taxable income being the ceiling that we've been discussing. All right, so that's the test. The other thing I do want to mention to you, though, is when we're looking at the phase-out amount, students sometimes make this mistake. They take their QBI and they say, where do I fall within this phase-out? It's not about QBI. It's about modified taxable income. So make sure you're using modified taxable income because sometimes your itemized deductions will take your QBI and it'll lower the amount to less than the beginning phase-out amount. And now so you want to make sure you're applying that green box because your modified taxable income was lower than the threshold amount. So here's what I'll do for you. I'm going to go ahead and I'm going to go back to those problems that we did before where we were calculating our modified taxable income. Let's go through and solve those to figure out, well, what is going to be our QBI deduction, and hey, what's our taxable income after we apply this QBI deduction. So that'll be our next step. And we're going to do the same thing for our above the threshold and within the threshold. So we're going to get plenty of practice on this. All right, well, let's move to the next stage then. All right, so let's go ahead and take a look at some of these problems so that way we can see if we can solve them when the modified taxable income is below the threshold. Right, so what I did is I brought these problems back from when we were calculating our modified taxable income. So we had James, Samantha, Carlos, Myra, and Taylor. In each of those problems, a QBI was provided to you. So we already knew what the QBI was. So for example, in question number 1, it said James owes a landscaping LLC and reports $50,000 at QBI. So we didn't have to do anything special with QBI. It was provided for us in the questions. But what we do have is modified taxable income. That's where we went ahead and calculated it. We said, okay, James, you had $50,000 at QBI, plus your spouse's $60,000 of W-2 wages. It gave us $110,000. And then we went ahead and we subtracted out the standard deduction, and the standard deduction was $29,200. So we got to our modified taxable income of $80,800. And that's what we compared to see where we were on that table where we below the threshold, above the threshold, within the threshold, and the threshold was about 191,000. So obviously on each of these questions, our modified taxable income is well below the threshold. So right now we're just dealing with questions below the threshold. Because we're below the threshold, it doesn't matter if we have an SSTB or not. We're treating them the same way regardless of whether they're an SSTB. That won't happen if we're making more than the threshold, but that's where we're at right now. Okay, so now that we know how to get to the modified taxable income, we know what the modified taxable income is, you're going to receive questions, I'm sure, on your exams, whether it's class, enrolled agent, or CPA exam. They're going to ask you, hey, what is your QBI deduction? And you're going to, okay, I can do this, because the QBI deduction is simply going to be 20% of your QBI, but it's going to be limited to 20% of your modified taxable income. So the modified taxable income is that ceiling, right? So if we have $50,000 as our QBI, we're going to go 50,000 times 0.20, and that's going to give us $10,000. So we say, oh, our deduction, our QBI is $10,000, but it could be limited. So we'll go 20% times our modified taxable income of $80,800, and we come out to $16,100. Well, hey, 10,000 is less than 16,100. The ceiling didn't come into play. We're taking all 10,000, all 20% of our QBI. That's going to be our QBI deduction. Awesome. We solved that one. So now let's go look at problem number 2. Now we have Samantha. We had our QBI of 40,000. We had our modified taxable income of 25,400. So we say, okay, let's take 20% of our QBI, and that gave us $8,000. Then we have to say, well, are we limited by our modified taxable income? That's the ceiling. So we take 20% of our modified taxable income, which was 25,400. That came out to 5,080. So if we look at that, when we see that our full 20% deduction would have been 8,000 for the QBI portion, but we don't get that, we have to stay at our ceiling. So we're only going to get $5,080. So that's one where the modified taxable income is going to exceed your QBI. Carlos had QBI at 35,000, so we'll go 35 times 20%. That gives us 7,000 QBI deduction. We're going to go ahead and see if we're limited by the 40,800 modified taxable income. Just looking at it, I know 40,800 is less than 35,000, but let's do the math. We go 40,800 times 20%. That's 8,160. We get the full 20% of QBI, so we get $7,000. And we do the same thing for Myra and for Taylor. So we have 30,000 QBI times 20%. That'll give us $6,000. And then we go 65,800 for our modified taxable income times 20%. That's going to come out to 13,160. And I'll let you just kind of work through Taylor's on your own because it's the same process that we just went through. So we solved the QBI deduction for each of those problems now. So on your exam, they could take it a step further and they could say, okay, well, what's your taxable income? What they want to know is we hadn't dealt with our QBI deduction yet. So now we need to figure out our QBI deduction and we need to go ahead and we need to subtract it from our taxable income to get to our taxable income. So what we have is modified taxable income minus our QBI deduction, and that's going to give us our taxable income. So let's look at the first one. 80,000 modified taxable income minus our $10,000 deduction. That's going to give us $70,800. That's our taxable income. But problem number 2. So Samantha throws a little wrinkle into this whole thing, and I probably shouldn't put modified taxable income. I need to explain what's happening on this one. So if we look over at the taxable income calculation, we're going to see it says 45,400. And you're looking on here, wait, where did that come from? Right? I see QBI 40,000. I see modified taxable income of 25,000. I don't see anything on here that says 45,400. Well, let's look back at problem number 2. All right, I'm going to read this to you. Samantha earns $40,000 from a consulting sole proprietorship. She also sells stock for $20,000 long-term capital gain. She is single and takes a $14,600 standard deduction. In that problem, we had capital gains. And we said, well, capital gains aren't being taxed as ordinary income, so we had to subtract it from our QBI deduction, right? So to determine our QBI deduction, we took out the capital gains. But now we're looking at, well, what is our taxable income? We're still being taxed on it, so we have to add that $20,000 back in for our capital gains. So what we did is we took our modified taxable income, add back our capital gains, and that gave us $45,400 minus our 20% of modified taxable income, which was our QBI deduction, and now we have 40,320. So this one was just a little bit different because we had those capital gains. Remember to add back capital gains when you're getting to taxable income. The capital gains are still subtracted when you're trying to figure out whether you're within the thresholds for the modified taxable income, and they're also subtracted out when you're figuring out your 20% of when you're figuring out your QBI deduction, your 20% of QBI or your 20% of modified taxable income. We only add it back for the final step. Carlos, let's look at Carlos. Nothing fancy about Carlos's situation. We have $40,800. There were no capital gains. So we take the $40,800 minus the $7,000 for the QBI deduction, and now we have taxable income of $33,800. We're doing the same thing for Myra and Taylor. There weren't any capital gains on either of those. So it's the same process of just figuring out our modified taxable income minus our QBI deduction gives us our taxable income. All right, guys, you're getting through here. We're already one of those tests down. So this is below the threshold. Doesn't matter if it's an SSTB or not. Below the threshold, you take 20% of QBI, 20% of modified taxable income. Here's the next great thing about this, though, that I want to kind of give you a heads up on. That 20% of QBI and that 20% of modified taxable income, that will be used in the same, that'll be used in our next two tests, right? If we exceed the threshold or if we're within the threshold, we always, always, always calculate 20% of QBI, 20% of modified taxable income. So what we just did here always applies. It's just that we'll have a couple different steps that we have to add in between before we're able to compare them. All right, so let's go ahead and we're going to go back to our thresholds, and we're going to talk about what happens if we exceed our threshold, if we have too much money. All right, y'all, we've now looked at what happens when it's below the threshold, when our modified taxable income is below the threshold, and we've been able to knock that out of the park. That's not an issue anymore. So what we have to do is we have to now head over and say, okay, what happens if they're making too much money? What happens if the modified taxable income is greater than $241,950 if you're single, or $493,901 if you're married filing jointly? Okay, if you see it, when you see that it exceeds the threshold, make sure you know if this is an SSTB. You know, is this a dentist, a doctor, a lawyer, a CPA, right? If it is, zero. Your answer is zero. There is no QBI deduction if you have an SSTB that exceeds those threshold amounts of $241,950 or $493,901. Of course, the threshold amounts always look to see what the current amounts are, but at the recording of this, that's the amount that we're using. Okay, so don't give the person who wrote the test or is proctoring the test the satisfaction of seeing you scrambling through all these problems and trying to do these calculations, and the whole time they know, the answer is zero, and that was it. Don't give them that satisfaction. Look to see if you have an SSTB so you can move on. All right, but let's assume that we have a retail business or something like that, or an engineer that was excluded from the SSTB definition. What do? Well, they still get a QBI deduction, but we just have an extra step that we have to do. So what happens is we take 20% of our QBI, just like we did below the threshold, and then we add this extra steps. We're going to have what's called Part A, and we're going to take 50% of W-2 wages. So if we pay W-2 wages to other people of $100,000, we get 50% of that. So we go $50,000, okay? That's Part A. We'd have 50% of W-2 wages. Part B, we take 25% of W-2 wages. So instead of $50,000, we have $25,000. Plus 2.5% of the unadjusted basis in your property. So look to see what your unadjusted basis in the property is and multiply that times 2.5%. Add that amount. So let's say it came out to $20,000. Add that amount to your $25,000, which was the 25% of W-2 wages. Add those two together and compare it to Part A, which was 50% of W-2 wages. We will take the greater of Part A and Part B. Take the larger amount. Then, after we'd selected the larger amount, compare that larger amount between Part A and Part B and compare it against the 20% of your QBI. We will now take the lower amount. So if your W-2 wages, 50% of your W-2 wages was a greater amount in Part A versus Part B, the 25% plus 2.5% unadjusted basis of property. If your W-2 wages were $100,000 and you took the 50%, it was $50,000, and that was a greater amount, and then we now compare it to our 20% of QBI. If our 20% of QBI was $30,000, we take 20% of QBI, the $30,000, and that's where we move on. We don't have to worry about anything else with that middle step. If, however, our 20% of QBI was, say, $120,000, well, $50,000 from Part A would be lower than the 120. We would only take $50,000 for that portion of it. Okay, so we take the greater of Part A and B, and then we take the lower of Step 1 and that Part A and B. Once we do that part, that's our QBI deduction, but we have to check to see if it is limited by the 20% of our modified taxable income, just like we did when it was below the threshold amount. Okay, so that's how we solve this. There's only one addition, that one Part A and Part B. That's the only addition that we added to this whole 20% below the threshold calculations. Okay, so Part A, 50% of W-2 wages. Part B, 25% of W-2 wages plus 2.5% of QBI. Take the greater of those, and then compare that to your 20% of QBI, and that'll be your full QBI deduction, although it could be limited by 20% of modified taxable income. So what we're going to do is we're going to work through a couple problems so we can make sure that you're able to do this when you see it on the exam. Okay, so let's go ahead and work through some problems. We have 3 problems that we're going to work through, 2 on the current screen, and then I'll do a third one. What we're looking at are situations where the modified taxable income is exceeding our threshold amount. So we're outside of that threshold amount. So we're going to work on the test that we just went through. So we have Rob and Linda file a joint return. Their taxable income before the QBI deduction is $600,000. Rob operates a manufacturing business that produces $300,000 of QBI. The business paid $80,000 of W-2 wages and owns equipment with an unadjusted basis of $200,000. How much is their QBI deduction? And we could have went through and said, well, how much is going to be their taxable income? So let's go ahead and figure this out. All right, we have our steps. We start out with step 1, and this is the same step we used when it was below the threshold. We take 20% of QBI. So if our QBI on here is $300,000 of QBI, which is provided in the question, we're going to go 300,000 times 0.20, which is going to give us $60,000. So we have 60,000. I'm moving 60,000 all the way over to my right because I'm eventually going to compare steps 1 versus step 2. So we have 60,000 for step 1. Then we go to step 2. And as we were talking about with step 2, we have a Part A and a Part B. Part A is 50% of W-2 wages. So in this situation, we have the business paid $80,000 of W-2 wages. So 50% of W-2 wages. So if we take the $80,000 of W-2 wages times 50%, Part A is going to yield us an answer of $40,000. So the amount for step 2 will be $40,000. Part B, what we do is we go 25% of W-2 wages plus 2.5% of the unadjusted basis in property. Well, if our wages were $80,000, we're going to take $80,000 times 25%. Okay, and that's going to equal us $20,000 plus we're going to go ahead and say 200,000. I put 20,000 down here. Sorry about that. It's $200,000 times 2.5%, and that's going to give us $5,000. All right, so if we have 20,000 plus 5,000, we're now looking at $25,000 for Part B. Our step now is to consider Part A versus Part B, and we take the greater of the two. So we cross out the 25,000. We're going to go with Part A, which is 40,000, because that's greater than the 25,000, which was at 25% of W-2 wages plus 2.5% of our unadjusted basis in property. Once we have figured out what part of step 2 we're going to be doing, the greater, we then compare that to step 1. And between step 1 and step 2, we take the lower amount. So if you look all the way to your right, the step 1 versus step 2, $40,000 is lower than $60,000. So we're going to accept $40,000 for this part of it. Now that's going to be our full deduction unless we're going to be limited by 20% of our modified taxable income. Well, our modified taxable income, it told us that the taxable income before the QBI deduction is $600,000. So we're going $600,000 times 20%, and that's going to give us $120,000. Well, we're looking at a $40,000 QBI deduction. That's less than the $120,000. So we're not hitting the ceiling. So we will take all $40,000 in this situation. So we have a $40,000 QBI deduction. If we wanted to take it a step further and say, well, what is our taxable income after the QBI deduction? We would say, well, our taxable income was $600,000, or modified taxable income was $600,000 minus our $40,000 QBI deduction. We'd have had $560,000 as our taxable income. All right. Well, let's go through another problem. Now we have Alex and Jordan file jointly and report $600,000 of taxable income before QBI deduction. Alex is an attorney and his law firm reports $300,000 of QBI with $200,000 of W-2 wages and $100,000 unadjusted basis in property. How much is their QBI deduction? Okay. This is the thing I've been warning you about, right? Don't let the person making this test trick you. We saw that they're an attorney, and we see that their taxable income is going, their modified taxable income is going to be over the threshold. Because they're an attorney, this is an SSTB, right? A specified services trade or business. And that means that we don't get any deduction. The answer is going to be zero. No QBI deduction at all because they are that SSTB. So we end right there. All right, let me go ahead and pull one more up for you, and that way we can work through another problem and make sure you have it down. All right, well, let's go ahead and take a look at one more problem above the phase out. Make sure that we have this down and that you're not going to have any problems when you see this on an exam. So you should be confident in it. So let's look at this question. It says, Sonia is single and reports $400,000 of taxable income before QBI deduction. She owns rental real estate that qualifies as a trader business. Her net QBI is $300,000. The activity pays no W-2 wages, but has an unadjusted basis in property of $1,600,000. So the first thing we do is we look at our modified taxable income, which is going to be $400,000. We're going to compare it to our table. We're going to say, okay, $400,000 for a single individual is going to be outside the phase-out amount. We're going to see that it doesn't look like she has a SSTB, so she doesn't have a specified services trade or business. So we should be good beyond that. So we're going to actually have to do our computations. We start out just like we did when it was below the phase-out, 20% of QBI. We always start out with 20% of QBI. And what we're looking at here is we go 20% of QBI times, so her QBI was $300,000, so $300,000 times 20%, that's going to give us $60,000. So I'll take that $60,000 for step one. I'm going to move it all the way to the right so I can compare it to step two. We're going to go $60,000 there. All right, now we go to step two. Step two is where we were taking the 50% of W-2 wages, but here we don't have any W-2 wages. So 50% of zero, zero, right? 50% of zero is zero. And then 25% of zero for part B is still zero. So for part A, our answer is zero. For part B, the first part of it is 25% of W-2 wages is zero, but then we take 2.5% of the $1,600,000 unadjusted basis in property. So when we go $1,600,000 times 2.5%, that comes out to $40,000. We take the greater of part A or part B. Well, 40,000 is going to be greater than zero. So for step two, we're going to take $40,000. We compare it to step one, which was 60,000. Between step one and step two, we take the lower of the two. So we will take $40,000. That's going to be the amount that we're going to use for our QBI deduction, but we're going to make sure that we're not limited by the ceiling, which is 20% of modified taxable income. We said that the modified taxable income was 400,000. So if we go 400,000 times 20%, that's 80,000. That would be the max we'd ever be able to take. But our QBI deduction from step 1 versus step 2 was 40,000. So that 80,000 ceiling is not going to limit us. Our QBI deduction is again going to be 40,000. If we wanted to go through and figure out what our taxable income is after the QBI deduction, we would take that 40,000 and subtract it from the $400,000 of modified taxable income. Our taxable income would be $360,000. All right, y'all. So you've done a lot of the heavy lifting. You've gone through below the phase out, above the phase out, and you've dealt with your specified services trader business. There's only one area left. It adds a little more, another test that we have to go through in terms of trying to figure out what happens if it is within the phase out. Okay, so that'll be our next task, is the phase out amount. What happens if it's in the phase out? I will tell you, I am not going to do any, it's outside the scope of this video, to do a within the phase out for an SSTB, a specified services trader business. You're unlikely to see that on the exam, but I will do one for a non-SSTB. All right, so here it is. This is the final one that we have to work through. So we've looked at below the threshold, above the threshold. Now we're looking at within the threshold. And what we see is a different test. Now this looks intimidating because now we're dealing with something that's going to be called the excess amount. We're going to deal with a reduction ratio. So it looks intimidating, but when you think about it, we've used almost every test already other than for really the reduction ratio. So here's how it's set up. The first thing we're going to do is we're going to take the 20% of QBI. Like I said, every single time we started out with the 20% of QBI, and every single time we end with 20% of modified taxable income. That never changed, and that's still true here. All right, so we take our 20% of QBI, and then what's going to happen is when we're dealing with the above the phase out amount, we used a different test. We said we take the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of the unadjusted basis in property. That's absolutely true in this case too, where it falls within the phase out amounts. But instead of, well, let's just go ahead and take that. We take the greater of that 50% or the 25% plus 2.5%. Now, what we do at that point is instead of comparing it to step 1 and taking the lower of those two, we taking the greater of that step 2, which was basically part A and part B from our previous test, and we're going to subtract it from our 20% of QBI. We subtract it. So if we had $300,000 was our 20% of QBI, and we had $250,000 was our greater of the 50% of W-2 wages or the 25% plus 2.5% unadjusted basis of property. If we subtract those, we have $50,000. That $50,000 is the excess amount. We have too much of it, so we have to reduce the excess amount. Well, how do we reduce it? Well, that's where when we come down here, it says determine the reduction percentage. Okay, so what the reduction percentage is it's a ratio. We're going to say what was our taxable income before the QBI, right? So we're going through and basically saying what was our modified taxable income, and then we are subtracting out the threshold amount. So if you remember the threshold amount from before for a single individual is like 191,000, slightly over 191,000. So if we are using this within the range, we know the income was within that range. It was greater than that $191,000. So let's say that it was $200,000. Okay, we would then say, okay, if our modified taxable income was $200,000, let's subtract it out by our $191,000, which was the beginning phase out amount, and then we're going to divide it by the range. The range will always be either $50,000 if you're single or $100,000 if you're married filing jointly. So if we're dealing with a single individual, we're going to take that range, or we're going to take that ratio. We're going to go our modified taxable income minus the beginning threshold amount divided by $50,000, and that's going to give us our reduction ratio, And at that point, we go back to this little step 1 and we say, okay, what was our excess amount? And in the example I was kind of articulating, it was $50,000. Well, if we said $50,000 times our reduction ratio, and that's telling us how much we're going to reduce it by for purposes of our QBI deduction, right? So we have our QBI amount equals 20% of the deduction minus that amount we reduced, right? Determine the reduction ratio, and then we're limited to 20% of modified taxable income. So like in the other examples, we'll work through a problem so you can see how this actually is applied, and then we'll be done with our modified taxable income, QBI, all that fun stuff. Hey everybody, we're almost there. Hang in there for a little bit longer. So we're now going to work on a QBI deduction that's going to fall with modified taxable income that falls within the phase-out range. So we've now worked through a problem or a few problems where we had a modified taxable income below the phase-out, above the phase-out, and like I said, we're doing the phase-out now. Before we do, hey, if this video has been helping you, please subscribe to my channel. I'm going to continue to do more videos on complicated tax issues in order to make it easier to understand for the CPA exam, the enrolled agency exam, and for your classroom exam. Okay, with that said, in 2025, Jordan, a single taxpayer, owns a retail business. It's a non-SSTB. Jordan's QBI from the business is $150,000. The business pays $50,000 in W-2 wages, has no qualified property. Jordan's modified taxable income is $210,000. Jordan has no capital gains or dividends. The 2025 199A threshold for single taxpayer is $191,950 with a full phase out of $241,950. So they want to know what is Jordan's QBI deduction, and we could take it a step further and say what is Jordan's taxable income after the QBI deduction. All right. So, as we think back through it, what's the first thing we always start out with? 20% of QBI. Good. So we have 20% of QBI. Well, this gives us our QBI in here. It tells us that our QBI, that the QBI from the business is $150,000. So we take $150,000 times 20% and we get to $30,000. So I have that for step 1. You can see that in there, $30,000. All right. Now in step 2, for step 2, what we're doing is the same thing that we were doing when we were looking at a situation where the modified taxable income was greater than the phase out, right? This is greater than the phase out. So what we're looking at is a Part A and Part B. Part A is 50% of W-2 wages. Well, it tells us our W-2 wages are $50,000. So for step 2, Part A, we're taking $50,000 times 50%, and we come out to $25,000. We're going to take the greater of that and Part B for step 2. Part B for step 2 was 25% of W-2 wages plus 2.5% of our unadjusted basis in property. Well, we still have $50,000 of W-2 wages times 25%. That'll give us $12,500. It says we don't have any property, so that's going to be 0. So we're going to go 25,000 plus 0 equals 25,000. So we're going to compare Part A and Part B, and we're going to take the greater of the two. Well, 25,000 is greater than 12,500, so we're going to have 25,000 as our answer for step 2. Okay. So when we went to 50,000 times 25%, it was 12,500 plus 0, so that was why we had 12,500. We compared it to the 25,000, which was the 50% of W-2 wages. So we took our $25,000. Now, what we do, and this is new for this phase-out problem, is we have to take the amount from step 1, all right, our $30,000 at 20% of QBI, and we subtract it from the greater of Part A or Part B in step 2. So we're going to take 30,000 minus 25,000. That's going to give us the excess amount. Okay, we're giving the excess amount. We didn't pay enough in W-2 wages or in property. We haven't made enough contribution. All right, so $5,000. Now we're going to have to reduce that excess amount. And how do we reduce it? Well, we have to come out with the ratio. Right? We're going to have to come out with the ratio. And the way that we do this is we're going to go with our modified taxable income, okay, our modified taxable income, and it told us our modified taxable income in the problem. It said is $210,000. So we had $210,000, and what we're trying to figure out is how far within that $50,000 range are we within there. So what was the beginning threshold amount? Well, it says up there that the threshold for the 2025 199A is $191,950. So if we go and we take our $210,000 minus that $191,950, all right, so now we have that, and then we're going to divide it by our $50,000 range. If you have a single individual, it's going to always be $50,000. If you have a married individual, it's going to be a married individual. If you have a married couple, it's going to be $100,000 that we're dividing it by. But since we're dealing with a single person here, we're going to go ahead and we're going to divide it by the $50,000. So what we have is $210,000 from our modified taxable income, and we can see this in step 4, minus the $191,950 divided by $50,000. It gives us 36.1%. So of that excess amount that we calculated in step 3, we need to reduce it by 36.1%. So if we come down to step 5 now, we're going to take that 5,000 times 36.1%, which equals $1,805. So we will reduce our 20% of QBI, which was 30,000, by step 5, the amount in step 5 of 1,805. So now we have a QBI deduction of $28,195. And we're going to then say, okay, our last step every time has been 20% of modified taxable income, because that has been our ceiling. Well, we have $210,000, which was our modified taxable income, times the 20%. That gives us $42,000. Well, this amount in step 6 was lower than the amount in step 7. So our $28,195 was less than $42,000. So our QBI deduction for this problem is $28,195. If you were asked, hey, what is the taxable income after the QBI deduction? You would have just taken your $210,000 modified taxable income and you would have subtracted out your $28,195, and that would actually give you your taxable income. Hey y'all, I hope this really helped. I hope that you have a better understanding of the QBI deduction and that you're ready for the questions if it's below the phase out, above the phase out, or even within the phase out. Again, if this has helped you, please subscribe to my channel for more updates as I work on other topics that often cause issues.